The Monetary Policy Committee is holding its first meeting for 2017. The Reserve Bank Governor will on Tuesday announce the first interest rate decision for the year. Analysts expect the bank to keep the repo and prime interest rate unchanged at 7% and 10.5% respectively. For more on this, we're now joined by Maura Feddersen, economist in financial risk management at KPMG. A very tough time for the central bank. No room to move as well. So how do they deal with this one?
Thank you, and thank you to your viewers. Well, the expectation is that tomorrow the repo rate will probably be left unchanged at 7%, which would keep the prime lending rate at 10.5%. And there are three key reasons why this is highly likely. First of all, although at the end of last year we saw high inflation at 6.8%, with food inflation at 12%, the expectation is that inflation will start to decelerate in coming months. And one of the key reasons is that we have seen higher rainfall. And so maize plantings have returned to a 5-year average. And the wheat harvest also was very positive, growing by 20% at the end of last year. So given that food inflation has recently been a key driver of inflation outcomes, if the agricultural sector will bounce back, then food prices will soften. So that is one key reason. Another key reason is that we are currently in a low growth environment. Last year we are estimated only to grow 0.5%, and this year perhaps around 1%. And so while we may have moved beyond the trough in our business cycle, the outlook is still relatively muted. And so the Reserve Bank has stated that they are very conscious of the growth implications of increases in interest rates, and so they would be reluctant to increase interest rates unless the inflationary expectations really warrant it.
And what are some of the key factors that would affect us in terms of what happens internationally? You know, the U.S. Central Bank also tightening as well.
Exactly. So what we saw at the end of last year was that the Federal Reserve, after much anticipation, increased the federal funds rate by a very small 25 basis points. And this was seen as a signal that the Federal Reserve is seeing economic growth in the U.S. as resilient enough to handle a stricter monetary policy stance. What is happening in the U.S. also has implications for monetary policy in South Africa. In general, what you see when the interest rate differential changes, so for example, the interest rates in the U.S. go up but not in South Africa, investors may want to move their capital funds across into the U.S., which would lead to a consequent weakening of the rand exchange rate. And indeed, that is what we saw short term, the day after the Fed's decision. The rand weakened by 3%. However, since then, the rand has strengthened again. And what happens when the rand is weak? We have higher risks of imported inflation because the costs of the goods and services that we purchase from abroad are higher in rand terms. However, because we've seen rand strength recently, and to date, in January, the rand has averaged around 13.60 against the dollar. So as a result, the Reserve Bank may not anticipate great risks of imported inflation, and so they may find that they have scope to keep interest rates unchanged tomorrow.
The expectation is that the rates will be unchanged, but what factors could play into the interest rate being raised?
Well, essentially the aim is to keep inflation in the target range of 3 to 6%. And if there are factors that are causing this inflation outlook to change, then this would be something that the Reserve Bank would have to take into account. And some of the factors we've seen recently, for example, the devastating drought had a strong impact on food prices. If we had a very high economic growth, then this could lead to excess demand, which would then also push up prices. The weaker exchange rate could create imported inflation, and that in turn could lead to the Reserve Bank having to reconsider. However, given that this is not currently the outlook, it doesn't seem likely for tomorrow at least.
We saw a year last year where the central bank first of all raised rates in the first half of the year and later halted. What kind of year are we expecting this year?
Well, it is likely that the Reserve Bank will actually keep the repo rate around 7% throughout the year. And this is based on expectations of around 1% economic growth, comparatively potentially tighter fiscal policy. Finance Minister Praveen Gordhan is having his budget speech in February, and the expectation is that he may announce increases in tax rates. So because of these constraints, it is unlikely that the Reserve Bank would be moved to increase interest rates unless something significant happens, for example, due to global developments.
And how great will the news be for consumers who are going out from a spending period in December and now are getting a reprieve from the central bank?
Consumers are in dire straits at the moment. If you look at savings rates, for example, they're very low. In fact, we are living beyond our means. And this is, of course, due to high unemployment levels and also the increasing cost of living. Between 2008 and now, cumulatively, the cost of living measured by headline inflation increased by 66%. So consumers are under pressure, and if you combine that with comparatively weak debt extension, then it is good news if interest rates would at least stay where they are.
Okay, now we'll keep our eyes on that tomorrow. That was Maura Feddersen, economist in financial risk management at KPMG. The city of Cape Town says it's not running out of water just yet, but the possibility of dam levels dropping to 20% is very real. It says city residents aren't heeding the call to save enough water and is promising even stricter restrictions.
Tougher water restrictions